In this section, we are going to cover the calculation of ratios for our company under question, Eicher Motors. So we've just put in 2 years of numbers for the company, the last 2 years of numbers that are available. And remember, they have a calendar year, which is which is January to December year ending. So this FY13 is essentially Jan to December 2013. FY14 is Jan to December 2014. In FY15, now they are essentially changing the year of accounting for April to March. So this year, it is January 2015 to March 2016. That will be the 15 month of results, and subsequently they will take it to yearly results, right? We've seen this earlier. So we have the P&L of the company here. We have the balance sheet of the company here, and we're going to calculate all the major ratios that we had discussed so far, right? So we are going to calculate the profitability ratios, we're going to calculate the return ratios, interest coverage ratios, stability ratios, debt to equity, liquidity ratios, and efficiency ratios, right? So these are the ratios we're going to calculate. We are also going to write down the formula here, and then we are going to kind of calculate it for each of the years, right? So let's put in the formula for operating profit margin. We will use EBITDA divided by net sales as the formula in this case, and we will try and calculate it using the numbers on the P&L. So where is the EBITDA? That's the EBITDA, 713, and you divide it by the net sales, which is net revenue from operations. Remember, you do not use other income while calculating operating profits. Why is that? Is because other income is non-operational in nature. If this was other operating income, let's say sale of spare parts, that for a company like Eicher Motors, which is a motorcycle company, sale of spare parts would probably be other operating income. But other income is like interest generated on money that you hold in banks. That is not dependent on the business happening, right? We are looking at only the operating profit. Operating profit has to come from business operations, right? So that's what we have taken, net sales. We can convert this to percentages. Remember, we have to convert these numbers to percentages, the profit margin numbers, and I can drag it on the right side. We see there is a jump in the operating profit margin of the company, right? Similarly, net profit margin is going to be net profit divided by net sales. Now, in this case, remember that when we look at the profit and loss statement, we do find profit after tax and we do find profit after tax after minority interest. Right now, if you're looking at net profit margin, it's a good idea to probably just take net sales and profit after tax. We don't subtract minority interest from here because sales is not adjusted for that, right? So we don't want to penalize the company on that. We take PAT, which is in cell row number 34, and divide this by the net sales, net revenue from operations, and we get a certain percentage number here. We'll again convert this to percentage by clicking here, and we see that net sales, net profit margin has also gone up over the last 2 years, right? So that's a jump in net profit margin. That there's a jump in operating profit margin. Basically, the jump indicates that there is an improvement in profitability of the company, right? So now it starts forming at least a semblance of a trend, which gives us an idea. At a later point of time, we're going to probably add a few more years to the company and see how the progression has happened over the years, right? Next, we move on to return ratios. Now, what are return ratios? As we discussed, how much return do you generate on some part of money that you have invested into the company, right? So there are multiple numbers. Return on equity, which is going to be net profit divided by your equity holders fund, right? Which is total equity. Return on capital employed, on the other hand, is EBIT divided by equity plus debt, right? And in this particular case, because there are minority holders as well, you add minority interest as well, because technically they have also put in some capital into the firm, right? So that's your return on capital employed, and return on total assets is EBIT divided by total assets, right? Now let's calculate them one by one. So the first one is net profit by total equity of the firm. Net profit of the firm has to be the profit after minority interest, because we're only looking at the equity holders value. That's going to come after the minority interest has been paid, right? So in this case, we will use row 38. Divide it by the balance sheet, total shareholder funds 2055, right? We must specify uh, after minority interest and net profit, right? So whenever we use net profit after minority interest, we'll mention net profit minus after minority interest, and we drag it on the right side. Again, percentage numbers is what it would be, right? Then we go and look at EBIT. Where is the EBIT? That is the EBIT, which is available to us, divided by the sum of the, if we go to the balance sheet, the equity holders plus minority interest plus long-term liability holders, right? Long-term liability holders usually is what is taken when you look at debt. If you want to make it a little bit more stringent, we can also add short-term borrowing to it, right? So this comes at around 18%, and we can look at 24.5% on return on capital employed as well. And finally, EBIT by total assets. So we look at EBIT, which is again row 26 on the P&L, divided by balance sheet total assets, which is going to be the same as total liabilities. But let's put it as total assets and click it. So those are the return numbers that we have calculated. Those are the return numbers that the company has said. Once again, you see that there is an increasing trend, which is a healthy sign. Prima facie, it is a healthy sign. Obviously, you need to do more analysis around it to understand what exactly is happening here. So prima facie, this looks like the company has improved its performance from 2013 to 2014. We obviously need to dig deeper to understand these numbers, but at least on calculation front, it starts showing that the trend wise, the company seems to be improving, right? So that's my calculations on EBIT by total assets and the return ratios, return made by all the major fund holders of the company, guys who have given money to the company. So in return on capital employed, we have taken equity plus debt. We were taking equity plus debt earlier, but in this case, because there are some minority interest holders as well who technically have given their stake to the company in the calculation of EBIT, right? Remember when we had discussed about consolidation principles, till the stage we have reached at EBIT. By the time we have reached at EBIT on our P&L, we have not really removed the interest of the minority guys, right? Only once we remove that is when is when we have arrived at the net profit, and we get net profit after minority interest. That's what is available to the equity guys. But EBIT is available to equity plus debt, plus they have a stake of the minority guys as well. So all these things get added in the stakeholders here in return on capital employed, right? Next, we move on to coverage ratios. Remember, interest coverage was basically the profit before interest and taxes divided by the interest paid by the company. What is that? So we look at EBIT, which is 583 divided by 8, right? So that's 72, and you have 89. Right now, this is a decimal number, and technically, this is a very, very healthy number. They have 70 to 80, 90 times of profit of their interest to cover their interest essentially. So even if things go a little bit wrong here or there, this number is fairly healthy. We will have a slightly more detailed discussion around this as we go along, but for all practical purposes, any number greater than 10 is extremely healthy, because then even if conditions change dramatically for the company is not going to default on interest, right? Any number below 1 is obviously a challenge, because then the company is already in a territory where EBIT is lesser than the interest. Any number just higher than 1 is also a dangerous territory for the company, right? Net debt to EBITDA is debt minus cash and cash equivalents, cash and cash equivalents, and you divide this number by the EBITDA of the company, right? So I should put this as cash and cash equivalents, and let's take that. So we take on the balance sheet, what is the debt number? Total debt is long-term borrowings plus short-term borrowings. minus, what is the cash number? So cash and cash equivalent is given here, and current investments is also cash equivalent. Current investments is investments in mutual funds and all, so that also has to be subtracted. So you find this is the number and you divide it by EBITDA. It's a negative number, which basically means on a net basis they don't have debt. So then it becomes a negative number is absolutely great. It kind of becomes meaningless in terms of looking at a trend, but they really don't have any net debt. So practically the number becomes negative, and the moment the number becomes negative, our analysis on debt is not really a very difficult task at that point. It's a fairly stable company, good amount of coverage that they have, and that should be good enough. Stability ratios, debt to equity. So I'm going to take total debt and divided by the equity here. And if we want, we can write total debt to equity of the company. And where do we find total debt? That's going to be on the balance sheet. And let's actually put a bracket around this. So on the balance sheet, we are selecting, and let's actually delete this and go and select the debt numbers. So this is the debt number plus, what is the debt number? Short-term borrowing divided by the equity number, which is here. Now again, as a rule of thumb, anything above 1 is where you start getting a little bit cautious, but they don't really have any debt. So compared to their equity, the debt is very low, and so for all practical purposes, fairly stable as a company. We don't need to worry too much about the debt numbers as such, right? So on stability and coverage ratios, this particular company is not in too much of a concern, so we are okay with this. What we do need to look at is liquidity ratios, which is current and quick ratio kind of numbers. Now, liquidity ratio, current ratio is nothing but current assets divided by current liabilities, and quick ratio is nothing but cash plus receivables plus cash equivalents and divided by current liabilities, right? I've removed everything else as well. So by hard and fast, there's no rule. You could take current assets and just subtract inventory from here, but I've removed other current assets that might be there as well, right? So let's calculate this. Current ratio is going to be current assets by current liabilities. So where is current assets? That's the total current assets, 2911, divided by current liabilities, that's 1987. So we look at 1.47 as the number. And then for quick ratio, I'm going to use, let's go to quick ratios, start a bracket, go to balance sheet, click on cash and cash equivalents plus trade receivables plus current investments. Technically, you can take short-term loans as well, but we've left that out in the formula. The only point worth considering is that you probably take all of that in consideration for all the ratios. So whatever formula you use the same formula consistently across the spectrum of your calculations, right? So quick ratio has declined, current ratio has also declined. Is this necessarily good or bad? We're going to discuss that more in our calculations on working capital analysis when we reach there. But at this point of time, that's just the broad calculation. We don't really know if this is good, bad, ugly. It seems okay. They seem to be able to cover their current liabilities using their current assets, and that seems like a fair enough position to be in at this point of time. So that's how we calculate liquidity ratios. Next, we move on to efficiency ratios, which is inventory turnover ratio, receivables turnover ratio, and fixed asset turnover ratio. Same formulas, we'll keep putting the formulas here and calculate the numbers downwards. So let's put in inventory turnover ratio, receivables. Remember, in our discussion, we had said that we will probably use sales everywhere. And why we are using sales everywhere is probably also going to form a part of our discussions on working capital. But for now, just stay with me and use sales by inventory, sales by receivables, we use sales by fixed assets, and sales by total assets, right? So we use sales by total assets. These are the numbers that we are looking at. Again, this will be times. So how many times does the company turn its inventory, right? We use net sales now, only net sales from operations divided by the inventory number. So where is the inventory? That's here. So the company turns its inventory about 12 times, 13 times effectively, right? Every time they get there, they essentially turn it about 12 to 13 times, which means whatever inventory they have, they will keep replenishing it at least 13 times during the year. Sales by receivables, higher sales divided by the receivables number. Now, technically, this is a business where receivables would not be too much, right? If you think about it, you pay before you get the bike, right? The receivables probably are coming because of their commercial vehicle segment. Remember, we're looking at consolidated numbers here. But in the two-wheeler segment, you don't really have too much receivables because most people will pay upfront before they get the bike, right? Let's look at fixed asset turnover ratio. So sales by fixed assets. So that's the sales number. And on the balance sheet, take the total of all the fixed assets. That's 2119. So what does it mean? Whatever fixed assets they have, they are able to essentially turn it 3 times. If they have 1000 crore of fixed assets, they will get 3000 crore of sales. Specifically 3200 odd crore of sales, right? Which is a good number, and they've kept this reasonably stable despite the fact that their fixed assets have gone up in the year, which means they must have done some capacity expansion and they have probably used it completely. Otherwise, if you just do capacity expansion and don't use it, then fixed assets will become higher, sales will not go up, and then this number should go down. The fact that this number is stable gives us some interesting points to ponder. We will ponder them in detail as we go along. Sales by total assets is going to be my net sales, net revenue from operations divided by my balance sheet total assets number, and that should also remain reasonably consistent as we look at it, right? So the company seems to be fairly consistent in whatever they are doing or slightly improving in whatever they are doing across these years. That's the numbers we are getting. That's how you basically calculate a set of ratios. Excel allows you to basically drag and drop all these numbers. So once you've calculated it for any 1 year, all you need to do is do it for the calculation for another couple of years, just drag and drop. The same thing could be done by putting another couple of years of numbers of the company in the sheet. Just put in the numbers for the previous 2 years as well, and just insert a couple of rows here, columns here, and just drag it on the left side or copy and paste it on the left side, and you will have the calculations available there as well. So that's the number, that's the trend that the company has seen in terms of these calculations on ratios. That's very important for us to know. This is how you would basically go about putting numbers for any particular company. Put the formula, calculate the numbers, and then the next stage is where we will start doing the analysis. So far, what we have done is taken out the numbers, put them from the annual report into the Excel file, and calculated the ratios. Now we are in a position where our question has to change to not just how were we calculating the numbers, but more on why is a certain number moving, right? So from now on, the most important question for us will become why. Why is operating margin going up? Why is return on assets and return on capital employed and return on equity going up? Why is interest coverage going down? That's where the entire concept of analysis will come in. So far, what we have done is ratio calculation. Now we will get into ratio analysis, where we're going to look at each of these numbers and get into detailed discussions around why those numbers are moving the way they are and why are some of these numbers important. When we do this, we will also look at multiple other examples of companies and how does that fit into the overall scheme of our ratio analysis bit.